Welcome everybody to GeoHug. So I am super excited that we've got Nicole Adshead with us today. So Nicole is a geologist with nearly 3 decades of navigating the wild and often bewildering world of mining and finance. So she's dabbled in everything from geology consulting, fund management, and investment banking to resource company executive and director roles. So if it involves rocks, stocks, and risk, she's been there and done that. And along the way, she's kicked rocks on over 300 exploration, development, and mining projects across 6 continents. So, with her expertise, it is going to be brilliant as she takes us through capital markets and the business of mining. Because bridging the gap between rocks and stocks isn't just useful, it's a survival skill. Whether you're trying to build a junior, advancing a project, or simply hoping to stay employed. So, thank you so much, Nicole, for joining us and spending this time with us and your knowledge. And yeah, it's amazing having you with us today.
Well, thank you very much for having me. It's a privilege to be on. You've had a very esteemed list of presenters.
Well, it's awesome to add you to the list, so thank you very much. But yeah, you have had such a varied career so far. So yeah, you are a geologist. What got you into the finance side of things?
Well, I finished my PhD in a bear market, and so I'd spent all this time being educated. I did not want to be an academic. Jobs are very, very scarce, and I thought I would actually like to make some money, and started looking at disciplines where I could use transferable skills. And came across this thing called finance and investment banking, and basically that started this road onto the finance trajectory. So it was kind of accidentally on purpose. And I do reflect that if I'd graduated in a bull market and I had been inordinately popular and had a lot of job offers, maybe my career would have taken a very different trajectory. And I think it's one of those things whenever you get an interview or people say, where do you expect to be in 5 years? I couldn't have predicted every time because my career has taken quite substantial changes along the way. So I turned to the dark side really due to external circumstances.
Yeah. And so, what have been some of the big standout highlights in your career so far? Like you've been to so many projects, so many continents. I'm, yeah, really curious with all your experience. What are some of your favorite moments?
Actually, I'm the kind of person that never has favorites because I think there's positives of everything. And I think that really the standout of my career and from the sell side to the buy side, I'm going to touch on what those concepts mean for those of your audience that don't know, is I got paid to travel around the world and visit projects from all different jurisdictions, whether it was from West Africa to Australia, to Latin America, to Russia, and got to meet incredibly interesting people, diverse cultures, and obviously kick rocks. And the one thing I would say, if you compare the finance side to the technical side of the business, and often the people on the technical side, you're dealing with tough jurisdictions and often you're in a tough environment. You maybe, don't have access to regular showers, for example. And I experienced that as a geologist. And there's a certain camaraderie that comes with that. And so that has been the absolute best part of the job. And now I'm no longer on the buy side working for fun, getting paid to travel the world and kick rocks. That's the bit that I miss the most.
Yeah, it is I think everyone loves being out in the field, so it's yeah, it gets missed a lot, I'm sure. Um
Yes.
but no, thank you so much for joining us today. I know you're traveling as well, so no pet rocks this time, unfortunately, but yes, we're so grateful that you're taking this time. So yeah, if you want to share your screen and we'll get stuck into it.
Brilliant. So I've become a devotee of AI recently. And so the photograph or the image that you see in front of me is me asking ChatGPT to provide an image that encapsulates the title. And I love what it comes up with because sometimes it's crazy. It's essentially someone who's missing a leg that's walking on a haul road, which obviously would never happen in reality, and lots of gold coins. But I'd advise you if you're in a moments of procrastination, it's fun getting ChatGPT to do things. Disclaimer, basically, I'm not responsible for anything I say, which is very, very typical of a finance person. So I have a platform here, so I'm going to use it. And I start off every single presentation I give the same way. And it probably becomes a little bit boring, but I think it's critically important because the biggest challenge that our industry faces today is one of reputation. And we have done an absolutely appalling job as an industry, and including the leaders of our industry, of promulgating and messaging what it is that we do. And essentially what we do is supply the raw ingredients for life as we know it. And without mining, our quality of life would cease to exist. And my sister, who's a cultural anthropologist, so lives in a world that's not necessarily in favor of mining. She has been somewhat corrupted by her family. And I think she said it best. She said that you can choose to be a vegan, but you can't choose not to be associated with the products of mining. And just an example of how poorly we have done, and I'm not necessarily picking on the UK, it was just easy to get this information. You have now 8 universities in the UK that are so anti-mining and have such a lack of understanding of where their stuff comes from that they will not allow any company that's linked to the extractive industry. So not just the big nasty guys in the room that generally get the negative focus, which is oil and gas, but also mining. They cannot come and present during Career Day. And when you think about that, like you look at the fashion industry, which is, I have a slight obsession with fashion, but stepping aside from that, but it's one of the most environmentally destructive industries there is. We don't need to replace our clothes as commonly as we do, et cetera, et cetera. But they've done a much, much better job than we have of messaging in a way that seems to be positively received. So, for example, these universities are not saying no to the fashion industry, but they're saying no to us. And that, I think, is a visceral demonstration of what a poor job that we've done. And I think also in the industry, we kind of buy into the negative rhetoric. And when I came across this, and so if you want to nerd out one day, great website called ourworldanddata.org. And I was stunned when I looked at this to see that this is global greenhouse emissions by sector, and it's a little bit old data, it's 2018, but essentially the ratios won't have changed. But if you look at iron and steel industry, that's 7.2% of global greenhouse gases, and non-ferrous metals are 0.7%. And I was astonished because if someone had asked me what those numbers would be, I would have said materially higher. So if we look at, for instance, energy use in residential buildings, 10.9%, you don't have people around the world saying stop building residential houses. In fact, in places like Australia and Canada and the UK, it's the complete opposite. So again, I think not only does whether it's the regulators, the politicians who won't lose votes for being negative on mining, we ourselves as an industry need to be very, very proactive as much as we can in terms of messaging what it is that we do and how important it is. Another point I just want to draw everyone's attention to, and I've been talking about this more recently, is we have this plethora of social media out there, and people like Jess are doing an awesome job of, I think, messaging and providing a real face and a range of faces to what it is that our industry is. But if you look at the average website, for example, of any company out there, they will not use these free media platforms that are available. And I think this is really interesting data because it just shows from a generational perspective which social media platforms are used by which people in terms of generation. And me, I'm in my early 50s. Of course, I look 25. I have a very different view in terms of how I communicate. And so I think it behooves all of us to understand how different generations like to be communicated to and then adapt our messaging to those platforms. And so really in a nutshell, what we should be doing is hiring millennials because they definitely understand social media in all its forms a lot better than we do. And just a small example of how one can have influence. Now, I have no influence. I'd like to think I have some, but I don't. I'm not important. But this is an example. The World Gold Council, I gave a presentation at the Denver Gold Forum last year, which essentially I started off with this messaging. And I criticized the World Gold Council, which is the leading advocacy organization for gold. And I said, look, this is an organization out there that is messaging how important gold is and advertising. And they're not even using these free social media platforms. And then by January, in 2025, when I went to look at it again, because I was giving a presentation, a short course on capital markets and for geologists, And then suddenly they were using everybody. And I think part of that was my messaging. And because after I gave this presentation at the Denver Gold Forum, I was contacted by a number of World Gold Council people that wanted to tell me how wrong I was and what a good job that they're doing. So just an example that all of us can I think positively impact things if we try to be proactive about messaging. Just going to touch through my career, and I'll keep this relatively brief in the context of the gold price. So in the 1990s, I was undergrad, PhD. I consulted throughout my PhD. So this is a photograph of me doing some structural consulting work in Papua New Guinea. Moved to Canada, terrible time in the markets in the early 2000s. It was very hard to get a job, but I managed to get a job for a little tiny baby junior, and great job because it really gave you have to become a jack of all trades working for a junior. But I discovered the horror of mapping in the Canadian bush. Canadian geologists are much, much tougher than Aussies because you have to deal with bears, and they don't give you AK-47s like I asked for. They give you bear spray, and you need to be within 2 meters of a bear for that to be effective. So this is getting dropped off by a float plane in the middle of nowhere, and we didn't see that float plane for another week. Then I moved to the financial side, and so that was the beginning of getting paid to really travel around the world and go and visit projects. And when you're working for a fund, you represent capital, everybody loves you, it's a fake kind of love, and you have to acknowledge that. But nonetheless, you get very well treated. And this is visiting a project in Canada that ultimately became, in Mexico, that ultimately became a very, very large mine. Then I moved to the true dark side. I moved to the sell side, where I was a sell side analyst, covering copper at the beginning of the bull market in all commodities, and uranium. And this is visiting a country that has the most amazing copper deposits that I've ever seen, which is the DRC. Then I moved even to the darker side, became an investment banker for 4 years until I decided I was too honest to be one. And this is visiting a uranium project in Peru. I went back to the buy side, underground in Tanzania, and then had my own company. So I do consulting and advisory work. This is visiting a project in Latin America. I was on a board. I've joined a number of boards and ended up running that company, Australian listed company with an open pit gold mine in Brazil. So I have actually sat in the hot seat and now experience what it's like. Instead of being the asshole asking the questions, I'm the person trying to answer difficult questions from investors. And this is an example. It's the only company that I've been involved in as a founding director and really helping create the company from the start. And I'm going to touch on this right at the end, where I was a leading director, a founding and lead director of a company called Bravo that's done very well. And that was one of my co-directors, Stephen Quinn. So just to touch on the flow of capital in the sector. And capital, we live in a business that is a depleting business. We need constant access to capital. We have immense costs associated with R&D. So I just want to touch on how capital flows through the sector. And people look at funds and say, well, funds are the supplier of capital, but they're not. There's capital providers, whether it's billionaires or family offices, etc., that want exposure in some way, and it's not just mining, it's to anything. So they're really the core providers of capital. And what happens is they want to allocate that capital. So they'll commonly use placement agents, which are essentially like a dating service that introduce the sources of capital to the people who will start to deploy that capital. And so when I talk about the buy side, that just covers really anybody who's actually spending money in the business. So it's from hedge funds, just super funds, people managing that, mutual funds, and includes obviously some of the biggest fund management group in the world, BlackRock, which is probably a relatively well-known name, to much, much smaller resource-specific funds. And the sell side are essentially the people that are taking that money, and they're intermediaries for the people that actually spend that money, which is the corporates. And so the sell side includes sell side analysts, it's the banks, it's boutiques, it's exempt market dealers, and the brokerage industry. And really, the only sector that you can think about that is constantly makes money in a very, very cyclical business is at every step of the way that this money transfers, it generates fees. And so whether the underlying sector is going up or down, or you're making money or you're not, it's the fees that are accumulated along the way that's the consistent source of revenue. So by the time that the capital gets from the original suppliers to the corporates that need it, a good probably 10 to 15, 20% of that has just been disappeared into money heaven in the form of fees. So I want to touch on something that I think is absolutely critically important, and even very large companies, I don't think about this enough, and it's this concept of NAV or net asset value. And very, very simplistically, it's your asset value that's defendable. And I won't necessarily go into details, but backed by, if it's an operating asset, something called discounted cash flow and cash, minus your corporate G&A and debt, and that results in your net asset value. And then if you divide that by your shares outstanding, that's your NAV per share. So why is this really, really important? It's important because if you any action that you take can increase your NAV per share or decrease it. And if it decreases it, you're destroying value. So for instance, if your NAV per share is less than, is greater than your value, and you issue equity that's accretive, but it's less than your value, then that's dilutive. So the way that I think that our industry needs to think about things more is how do we behave in a way that's accretive, that creates value for the owners of our company, which is essentially shareholders. So we live in a cyclical industry. If anybody tells you this time it's different, run away and run away screaming. And so from my perspective of spending a lot of time in this industry, and I think this is the frustrating realization that you have to come to, is that investing and corporate behavior, depending on where you are in the cycle, is generally very, very, very predictable. Essentially, we're doomed to make the same mistakes again and again and again. And there's very, very few companies that don't. But if you acknowledge that behavior is very, very predictable, I think it allows you to better control your circumstances, whether that's working in the industry, deploying capital in the industry, working in managing exploration, for example, or trying to capitalize a business as a small company. So just some examples I'm sure everyone's familiar with, going back to 2006 and just showing a very long upward cycle in the gold sector, for example. So I've got gold here, capital and lithium. It's very hard to get lithium back unless you pay tens of thousands of dollars for Bloomberg, which I will not be doing. So this is SQM on the bottom, which is a very good proxy for lithium. It's one of the largest lithium producing companies in the world. So really what we're showing is that commodity prices go up and commodity prices go down, and you can have long duration cycles, which is I'd argue you see in gold, and you can have much, much shorter duration cycles in other commodities. So what I've done here, what I'm trying to show is the cycle in terms of the swag that you get given on site visits. So in a bear market, when times are terrible, you're lucky to get a pen on the top right. And so what are the various indications of a bear market? Number one, that's when all exploration geologists get fired. You have mass geological firing, and that in and of itself is one of the reasons why we have an aging industry. It's hard to attract younger people, and I think that's a very, very big risk. But if you lose your job, you tend to go, well, I'm sick of this, I'm going to go and find something else to do. And unfortunately, that's what happens. So in a bear market, very, very standard criteria. You have prices fall. It's when the generalists are exiting left, right, and center. You normally have bankruptcies. You have asset sales at the worst possible time. Everybody hates the sector. They say they're never going to come invest in it again. Investors demand capital discipline. So they don't care about growth. All excess discretionary expenditure stops. So exploration ceases to exist. And everybody is just focused on trying to keep alive as a company. And investors are demanding discipline, and that's a key. Now, as prices stabilize, which is what they always do, so you see balance sheets start to improve, you start to see the underlying commodity price improve, and this is a time when low-risk corporate behavior starts to occur. You go on a site visit, you start getting slightly better swag, so you'll get a very ill-fitting shirt and maybe a baseball cap that you can work away with. But then you see corporates starting to indulge in low risk M&A. And by low risk M&A, I mean like with like. So you'll see large producers merging with large producers, or producers acquiring producers. You start to see green shoots of low risk capital available. And so that might be for a tier one asset that's expanding, or it might be for an exploration discovery that everybody is enamored with. And that's when you start to see some early exploration or the R&D of our business occurring. As the cycle continues, and I would say this is the beginnings of a bull market. We tend to say it's a bull market when it's crazy behavior, but there's very early signs. Go on a site visit, you might get a nice Sally Hansen ski jacket, some mugs, a better quality hat that actually protects you from skin cancer. And this is when medium risk capital becomes available. So you start seeing more capital being deployed into the exploration sector. Obviously, if you're putting exploration dollars into the ground, theoretically, you'll be getting some new discoveries. We know that when there's some discoveries, the market starts to get excited by that. And people think, well, if this company had one, maybe the geological gods will be shining on other companies. And so we want to start indulging in that gambling behavior. You start seeing the underlying commodity risks increase. And this is, in my opinion, where you start seeing resource investors, so these investors that have a better understanding of the sector, start to deploy more material amounts of capital. You start to see higher risk M&A. So that might be a very high quality development project. You start seeing premiums paid for acquiring projects increase, and investors start to change their tune. Instead of going into a meeting with an investor and they're saying, all we care is about a balance sheet, we want to see return of, whether it's in the form of dividends or buying back shares, we don't want you spending excess money on anything except improving your balance sheet. They start asking questions about growth. So they're saying, well, when are you deploying capital? You know, you've got either declining production profile or it's stabilizing. Where is your growth coming from? So that tone of that entire communication starts to change. As a cycle matures, the kit swag you get gets better, including nice hand lens, binoculars, for example. And when you're at the beginnings of what everybody starts to call a bull market, you start to see more parabolic performance in the underlying commodity price. And the tone from investors changes from talking about growth to really demanding it, saying, well, we want to see growth. People start getting more confident. They start building debt on the balance sheet. You start to see an increase in IPOs with small companies. So we saw that in the lithium boom, which was a very contracted boom really between 2020 and say 2023, where if you just had lithium in the title of your company, you could raise money at hat. High risk M&A starts to explode. And what's happened is all the easy, good M&A has essentially been done by the time you hit this point in the cycle. And everybody's running around and competing with each other. And so when there's competition and you're scared you'll miss out, you become probably more emotive and less rational in your decision making. And what starts to happen is the easiest way to grow is to acquire it, or it's to reduce your gold price assumption and reduce your grade cutoff assumption in your resource reserve estimates. And that has a trickle down effect, obviously, in the margin. So even though you might have an increase in the underlying commodity price, you can start seeing margins declining. And then what I think is absolutely stock standard, true bubble-like behavior when you want to run screaming. If you're an investor, you should be selling everything. If you're a junior company, you should be raising as much money as possible. If you're a major, you should be selling underperforming assets. And again, you see this very, very predictable and typical behavior. So you start seeing leverage companies outperform. And so leverage companies are those companies that actually, they're not good companies. They have a very high cost profile, but that profile then means that when the underlying commodity price goes up, they've got more of a beta to the underlying commodity price. You just see a huge number of capital rises, so equity financings, the dollar value of those financings increase and the volume of them increase. Moose pasture becomes highly valued. I was covering uranium for the crazy uranium bull market of 2005 to 2007. And it was insane. I would go marketing to generalists who couldn't spell uranium 6 months previously that would be debating with me about a company that had moose pasture, literally boulder samples in northern Canada that were trading at $100, $150 million. So there's this irrational element because when people see a chart going like that, they think it's going to go like that in perpetuity. And what you start seeing is generalists are entering the sector en masse. And so I probably rather critically call it dumb money. And it is, it's obviously a bunch of smart people, but a lack of expertise about our sector. And so when you see the generalists pour into a sector en masse, and that was absolutely the sign of the top of the lithium bull market, that is when everybody else should be selling. And I would note here is when everybody's desperate to hire geologists, and we've seen this time and time again, and pulling geologists out of third year, and you no longer need an honours degree if you're being educated in Australia to get a job. When you see that kind of behaviour, that's the sign of the top. And this happens time and time and time again, and it happens across every single commodity type. So thinking that this time is different, it's never, ever, ever different. So if you understand this and accept this and adjust your behavior accordingly, and frankly, very, very few groups in our sector do, you can make a lot of money or you can have a lot of success. So just moving on to how I look at the sector, where you are in the cycle dictates really everything. So you really need to have an appreciation or an understanding and be as objective as you can about where you are in the cycle. For me, people are absolutely the most important ingredient. You can have a mediocre management team destroy value in a very good project, and you can have a very, very good management team create enormous value in a mediocre project. And by people, I mean, so for example, if we look at a junior exploration company, you'd want to see a board and management team that, of course, has technical expertise, that has, if you're in another country, has country expertise. And I can't emphasize how critically important that is. So it's people that speak the language, that understand the culture, that understand the regulatory environment, and having those people in positions of power in your company. So in your senior leadership and also on your board. So many times when companies have issues in another company, they blame in another country rather, they blame the country rather than their management of their business in that country. And so you want to see a diverse skill set. You want to see whether it's legal expertise, capital markets expertise is really, really important, because at the end of the day, a lot of the financial advisors, they're not your friends. They will take you out to nice dinners and wine and dine you if you have something that they want to be involved in, but all they care about is generating a fee. So you need people intimately involved in your company that you can trust, that will give you the truth about what it is that you should be doing, or advice that's not linked to just simply generating a fee. Project obviously is critically important. The most important element of any project is its geology, it's the rocks. You can work on absolutely everything else. You cannot change the rocks. You can work on engineering, you can work on MET, you can work on community relations and your social license. So, and grade is the biggest risk. And so if you have a project, if it's got a fatal technical flaw in the form of a resource estimate, you're screwed. So that is the absolute fundamental key element is technically, does it hold water? Place obviously is very important. I think we tend to have a bias, an Anglophone bias to Australia, Canada, and the States. And people say that those are low risk jurisdictions. They're not, they're simply not. Risk manifests, every single country has risk, and it manifests itself very, very differently depending on where you are. In America, Australia, and Canada, it's permitting risk. It's very, very difficult to get permits in, and it's often, whether it's state or provincial specific, but permitting is a very, very big risk. In the States, for example, even once you receive your permit, the way that their litigation law works, you can essentially be sued into non-existence as you try and battle entities that are trying to stop the mine going forward. And then other countries that have this high risk perception. So Brazil is considered by some people, and I've got a lot of experience in Brazil for a gringo. I think it's one of the best places to work in the world if you have Brazilians that you listen to are in key positions within the company and understand the environment. Strategy is critical. Basically, you have to have one. You'd be surprised how many companies don't. And that strategy has to make sense in the context of where you're on the cycle, and also the size of your company. If you're a tiny junior with a $10 million market cap and $2 million in cash, saying that you're going to advance a project that requires, initially $20 million in drilling, that's a capital mismatch. So the strategy has to make sense in the context of what you are and where you are. Cost of capital is key. It's generally very, very high for most of us. For those very few souls, and I would put Robert Friedland in that category, the Lundin family, various very, very successful history of successful people in Australia. If you've had success, your cost of capital is essentially zero, if not negative. So Robert Friedland could go out and raise money, hundreds of millions of dollars for any wild, crazy idea, because he and his team, and I think I saw Doug Kerwin's name, he and his team have, and this is the geological brains, shout out to Doug Kerwin et al., they have had more discoveries of tier one assets than any of the majors in the last probably 20 years. And I think one of the reasons for that is very uniquely and rarely is Robert and his team, I think, listens to geologists, pays geologists well, and gives them money to actually go out and drill projects, and does this in the good times and the bad times. And that's not what you see in the so-called leaders of our industry. Of course, you need to have catalysts. Catalysts move share prices. I'm going to touch on this. And in our industry, what moves share prices the most, and it's why we keep coming back to it in the small sector, are drill results. And promotion is a dirty word, but in mining, you have in excess of 3,000 publicly listed companies, from exploration through to including the majors, that are listed globally. So you are competing, you've got a lot of competition for a finite amount of attention and a finite amount of capital. So you have to think of some way to stand out from the crowd. And lots of people say, well, I don't like promotion, I'm not very good at it. When you think about it, throughout your career, you have to be able to promote. You have to be able to promote yourself in a job interview. You have to be able to promote for competing, for example, maybe for an exploration budget. And so being able to message your story well, and in a way that resonates, whether it's with investors or all of your stakeholders, is absolutely critically important. And it's one thing that I think is not focused enough on during your university careers. So what causes share prices to move? You'll see people talking about beta, and that's just essentially when the gold price goes up, for example, almost every company will go up at a rate that's similar with the underlying commodity price trajectory. People talk about alpha, and alpha is just simply events that drive share price movement above and beyond the underlying commodity price. The one that everybody loves, it's drill bit success. I think those that are invested in our industry, we're both optimists and gamblers at heart. But one of the reasons why you do see a lot of retail interest in our sector is that there are very, very few other sectors where you can have one piece of information, and that's a drill result, that can move a share price 100% in a day. It can move a share price 1,000% in a week. Essentially, no other sector has that ability to result in such dramatic short-term share price movement. And that's why we have this high-risk capital that's attracted to the sector. Share prices move due to takeovers, and that's both the anticipation of being taken over, because they generally occur at premiums. And if you look at the preceding 30 years, the average takeover premium globally is 30%. So that's a pretty good lift in a day. So that's anticipation. And then when the takeover actually occurs, executing on your business plan. That sounds really, really simple, but very few companies do this well. The rarest commodity in our business is trust. And if you can simply do what you say you're going to do, you're a rarity. So executing on your business plan and being trusted by the suppliers of capital can result in outperformance. People and promotion, again, kind of cottoning back to that theme of standing out from the crowds. And this to me is somewhat irrational, but you can just have somebody, whether it's a well-known investor, so in Canada that might be Eric Sprott or Michael Gentili or Rick Rule. Simply people being aware that they've invested in a company results in share price movement. Nothing else has changed, but that demonstrates that I think a lot of people like to be led and they like to follow. And when someone does something, that can result in outperformance. Or changing management teams, or bringing a well-known individual who's associated with success onto a board. All of those things can move share prices. Political risk changes obviously have a material impact, and probably the most significant one that's occurred recently, that anybody that had a company in Russia when Russia invaded Ukraine, obviously that was I I think at the time we thought that there was a chance, but that was exogenous risk. Those companies that had assets in Russia, you can't move your widget factory, obviously precipitous decline in their share prices, no matter how well you run your business or how good your assets were. Just touching on examples of beta. So this is gold and yellow, and this is the GDX and the GDXJ, which are the two go-to ETFs that people look to compare themselves to. So the GDX is larger companies, GDXJ is smaller. And this is just showing their relative performance to gold from 2015. So that's from the bear market, that the nadir of the bear market in 2015 to now. And just one thing I want to point out, if you look on the right-hand side, is sorry, actually, if you look between 2016 and 2019, for example, you could see the gold price was slowly trending up and you had massive outperformance in the equities that were exposed to that. And probably I would call that a relief rally. What's interesting about now, you've got parabolic gold price performance, yet you have got underperformance in the equities. And I'll touch on why I think that is in a little bit later. Essentially, what I think this means is that we're in a bull market, but the equities aren't responding like we are. So there's a real opportunity to be exposed to lower valuations. This is an example of a discovery. This is a Canadian company that's had an exceptional discovery in Yukon called Snowline. And so I can't see my screen on the right-hand side because my face and everybody else's face is in the way, but in excess of 1,000% in 3 years. Wonderful job, great team, great discovery, just showing what can happen based on that thing that we call drilling. This is an example of executing. These are 3 companies. So Emerald Resources, Capricorn listed in Australia, and a company called G Mining in Canada. And they've had unbelievable share price performance over the last 5 years. And this is not due to discovery. This is due to acquiring assets, orphaned assets, really at the bottom of the cycle when nobody was interested, and essentially executing on a business plan, and that's building them. So even though we tend to look at the build phase of our project, of a life cycle of a company as being a negative, it's called the Lassonde Trough, and I'm going to go through that. This is examples of companies that can execute, that have management teams that have a reputation of being able to execute. Their projects were all very similar. They were all gold. They were all open pit. They were all CIL amenable. They were all technically simple in some ways. But these are 3 disparate companies that what they did was, this is our business plan, we're going to build a mine, and they did what they said they were going to do. And if you can do that, that can result in outsized performance. So this is an example of a company that was outperforming its benchmark, which was the GDXJ. It had no news, but why the share price was moving so rapidly was there was anticipation that it was going to get taken out. And that anticipation was being driven by Barrick was acquiring a lot of ground contiguous, and it was public that they were making those acquisitions. And so the market went, well, Barrick must be interested in taking it out. So again, an example of what things can move share prices. So this is the Lassonde curve. Pierre Lassonde, very, very well known in mining superstar in Canada. I think everybody understood and talked about this curve, but his name got attached to it. So he will be preserved in the annals of history. And this is just showing that there's generally very, very predictable share price behavior, depending on where you are in the evolution of your life cycle as a company. And this is really most applicable to smaller companies or single asset developers. And essentially what it's showing is that when you're in the discovery phase, share prices talk upwards dramatically. And the reason is when the upside is unknown, everybody assumes the upside is limitless. And when reality or the truth meter comes in, and that initial reality injection is a resource estimate, almost every single company disappoints when they put out a resource estimate. And that's because companies, when you think about it, when they press release their drill results, you're highlighting your positive drill results. So that's the best of the bunch. It is not representative of your ore body. And so 99.9% of individuals that invest in mining are not technical. So they don't necessarily really understand that. So they're just kind of looking at these great numbers and thinking that's representative of reality. And so then what you see is this downwards trajectory in the share price as the project actually becomes more real, and basically becomes de-risked because you're starting to do met work, etc. You're permitting, but it's boring. You don't have the sexy, exciting news results. So you see a very, very strong downwards movement in the share price. And then as you you've de-risked it, you've gone through the permitting hell that's normally that we all experience, and you financed it, and you actually build on time and on budget, which basically never occurs, you start to generate interest in the share price again. And this ebb and flow of your market value is very, very predictable. And so you as an investor should understand that and invest accordingly, but you as a company should manage your business accordingly. And also, as you go through the life cycle of your company, the questions and the tone of what happens changes. So at the start in a discovery, all anybody cares about what's the quality of the rocks, essentially, and how much of it do you own. And then by the time that you've advanced it into the reality phase, it's very, the tone has changed. And so how you market has to change, and how you present yourself has to change. Now, I just want to touch on this is back on the relative value theme, is your market value. So this is what the market is willing to pay you for your project is in the yellow. Your real value, your defendable value is in the green. And so if you can see the green on the bottom right in the dashed line, you can see that the market value is much, much higher than that green line. So that means you're trading at a material premium to your underlying defendable value. So what does that mean? It means you should raise as much money as possible in this phase. And basically no company does. And I don't know why, other than the fact that when you own something, you value it very, very highly. And you too start to drink the Kool-Aid and to buy into your own story. But if you have a share price like this, you raise as much money as possible. And generally, you want to sell before they release a resource estimate, because it normally doesn't meet expectations. And so if you're a junior, you've had a great discovery, in my opinion, you should be raising enough money to get you through to a construction decision. And very, very few companies do that. And you should be even raising money as you're on the downwards trajectory. And the problem is, again, we get anchored by our highest price, and you might be at, say, $2 and you're $1.90, and you go, well, I don't want to raise money. I was at $2. Irrational behavior, because most companies that do that, I'm going to show a couple of examples, then you might be raising money at 10 cents. So this is an absolutely critical chart. And it should be used as an educator to when you should be raising money and how much you should be raising. So this is a Canadian example that doesn't exist from the last cycle. They had a great discovery in Yukon. Everybody said it was going to be the next Nevada. And they, trading at the top, had an 800 million market cap on no resource, just on drilling. And they only raised 23 million. And they essentially sold themselves how many years later? 10 years later, for $31 million. And we're trading at 14 cents a share. That pattern is the pattern that most companies with a discovery go through. Very few discoveries continue with an upwards talk. This is an example of perfection. This is Great Bear again, and they had their discovery. And what's amazing about Great Bear is those red dots are every single time they raised money. And as you can see, they raised money, and this is almost unheard of, at always higher and higher and higher prices. So they were very rational in how they conducted their business. They were eventually acquired by Kinross at a multi-billion-dollar valuation at 57% above their last financing price. So essentially anybody that ever owned shares in this company made money, and they never had a resource estimate. And at the time they were acquired, I was talking to one of the directors, and he said they had really stroppy shareholders that were calling up and going, how can you possibly sell yourself? You've got 15 million ounces, you're going out too early, et cetera, et cetera. When Kinross came out with the inaugural resource estimate, 18 months later, they had a total resource of about sorry, I can't see what the indicated is, but around 4 million ounces. It was materially less than people's expectations. So if Great Bear had continued to exist as a company and come out with that resource estimate, there would have been a precipitous decline in the share price. This is perfection. This is a company that did an incredibly good job for their shareholders, but very, very rare, something that we should all abstain to. So what does this mean? Simplistically, if your value is above your share price, the most accretive thing you can do is issue equity, do a financing, or acquire something or sell. And if you're trading below, if your NAV is below your share price, your options are much, much more limited. Reduce expenditure, hopefully increase in IR, or even sell yourself. So selling yourself for a premium is not a negative thing at the end of the day if you're creating value for your owners of your business. Just wanted to touch through on an example that I've been intimately involved in, which is Bravo. So this was an asset that was in the bowels of Vale. It was a PGM plus nickel asset that had been discovered in the early 20,000s, actually, that shouldn't say 2020s. The person, a Brazilian, had access to it. He wanted to list it in Canada. I had met him when I was running Bedell. So he approached me to see if I was interested in and being involved in the company. And to me, this was almost a perfect story because it was a company that had material exploration success. It was very, very de-risked because there was a historic resource estimate. We knew that mineralization continued because I'd only drilled 2 deep holes. And for me, it was a company that was exploration without exploration risk. So that is a very, very, very easy story to sell. He had secured the asset. We began marketing heavily at the end of 2021. And I suppose from my time on the buy side, I have a lot of former peers that trust me because I was in the trenches with them. And so we reached out, marketed very, very heavily, did a private financing where we got a number of very sizable funds involved, including BlackRock, which very rarely invests in private companies. So raised a substantial amount of money pre-IPO and started drilling because everybody loves drilling. And then IPO'd in the middle of the next year. So we raised money at 50 cents a share. We completed IPO at a pretty bad time in the markets in mid-2022. But our strategy here, and this is really driven by, I suppose, my view on how you need to manage your business, was too many companies, when they IPO, they raise a small amount of money. And we're thinking, well, we don't want to dilute ourselves too much. We know we can come to the markets. We're going to do so well because all of us do, and we'll raise money at high prices. That basically never happens. So my take on it was that we need to raise enough money to essentially be able to say that we can fund us for 3 years. So if you raise money but need money in 6 months, there's no incentive unless you have an amazing discovery for people to want to own or buy your shares. And so I think we were very strategic in terms of how we marketed it and how we messaged it. And so we raised a material amount of money, enough to fund exploration, had a very exciting exploration story because it was a known resource. We knew that it continued with depth and very, very active drill program. Share price did very, very well. And then the company raised money again at $3.50. So really trying to replicate that Great Bear example. So this is the share price performance, and from the IPO through to its peak in mid-2023. And that was driven by very good messaging. The fact that we said, if you want to be exposed to this company, you have to go and buy in the market. So the share price was getting supported in the market, and it was a messaging that was very, very focused on exploration and exploration upside. And we think that this could be a tier 1 asset. And then I left the board and I was very heavily involved, I suppose, in the messaging. And I left the board, actually, in hindsight, it was at the top of, and I still own all my founder shares. It was at the top of the market, at the top of the company's share price. And this happened in the context of a declining PGM price environment. So this outperformance wasn't being driven by the commodity price environment. And this shows that drilling, you can, at any time in the cycle, drill results can result in positive price performance. So then this is the example, this is share price movement from IPO to today, and you can see it went up and then it went down. And so I think one of the reasons why the company went down and I was no longer involved intimately is the messaging changed. The messaging changed from we're about exploration, exploration upside, and this is a growth story, to one of development. So that we're going to advance it through permitting, that we're going to develop. And then investors become very uninterested when it's a developer. And that happens again time and time and time again. The only time you get rewarded for being a developer really is in a crazy bull market. And then the share price went up again, and it went up to that thing that we all know and love, which was drill results. So absolutely spectacular drill results, world-class results, and really showing evidence of a different type of mineralization. So everybody got excited about the tenor of the drill results declined. So obviously share price performance declined, but there's been a real focus, if you go and look at the messaging of the company, kind of around exploration upside again. So just showing how important it is to market your story effectively and in a way that resonates with the other side. So I wanted to talk about themes in our sector. You tend to see companies doing what other companies do. There's very, very, very sheep-like behaviour. So an example of that from 2018 to 2022, almost every large Australian company acquired assets in North America. And I think simplistically what happens is boards and management teams will sit around, and when one person does it, people go, oh, well, we should be doing that. And that in itself is what happens at the latter stages of a bull market, when you tend to get a feeding frenzy in M&A. Another more recent example is we had BHP and Lundin acquire a fantastic discovery on the border of Argentina with Chile. This is an exploration company. So acquired for $4.1 billion. They paid a 32.2% premium. And then within a relatively short space of time, Agnico Eagle, who's dabbling its toe into the copper waters, invested, its ATEX markets itself as a philo lookalike, made it a material investment into ATEX. And so you do tend to see these themes in our sector. Newmont asset sales. So Newmont has been divesting itself of non-core assets, and they have gone out. They initially were messaging that they thought they could sell them all for around $2 billion. They sold them for in excess of $4 billion total. And what has come out of this is where this happened in a rising gold price environment. It was a very competitive process. All of those companies that missed out, when you miss out on something, there's a very emotional response to that. And so all of those companies out there are looking to fill their production gaps. And what further makes people excited about acquiring M&A is these are two companies that have an exceptional price performance since making acquisitions, which is Orla and Discovery Silver. So all they did was pay very high prices for producing assets, and the market has said, we're in a rising gold price, we are going to reward you for growth. So other companies are looking at this and going, well, we want that share price exposure too, so we need to grow. And just to end with where I think we are in the market, this is where I think we are. I don't think we're in a crazy bull market. The equity valuations don't support that, but we're seeing behavior that is definitely past the green shoot stage of the beginnings of a bull market. We're seeing a lot of M&A in the gold sector. We are seeing a lot of competition. There's a lot of companies that have missed out. Investors are talking about growth. The sell-side community is talking about growth. So it's a very interesting time to be exposed to the market. And I will end it there.
Thank you so much. That was super useful. I learned heaps just then. So thank you for that.